So it looked like a rather flat night on the US markets overnight, but in fact it was a pretty wild ride early on. I'm joined by Adam Carr from Business Spectator. Adam, the Nasdaq was smashed early, wasn't it? But then the markets recovered.
Yeah, look, absolutely. You know, when the US markets opened, it wasn't too long before we saw some tech selling again, all the sort of high growth stocks. And at the low, the Nasdaq was down about 1.9%. So it looked like a pretty atrocious session early on. But I think in a telling sign, that brought in value buyers. I don't think the market is prepared to push the tech story too far. And in the end, the Nasdaq was basically flat.
Now, one of the things about that sell-off was interesting, the rotation out of some of the higher growth ones like Facebook, Amazon as well, had some pretty heavy selling, but into the likes of Apple. Is that a sign that people are looking much more strongly at, okay, where is the revenue coming from? Where are the profits coming from?
Yeah, absolutely. I think that the onus is on earnings now, and investors are increasingly saying, "Okay, well, look, we've had a great time. Market's doing very well. We're seeing articles saying that the only thing that's going to sort of bust this bull market is a recession, and the chances of that are pretty low, as the IMF tell us. But now we need to see earnings growth, and absolutely, investors are, a lot's been priced in, and now it's time to see the money, as it were."
Now that earnings will come from the US consumer mostly, so there was some good news in terms of house sales last night too, wasn't there?
Yes, look, absolutely. I mean, taking the housing market, as a separate sort of thematic, seeing a lift in pending home sales is a sign that consumers are feeling happier about things. And remember, we saw last week consumer confidence lift, and this result last night for pending home sales kind of confirms that. It suggests that 70% of the US economy isn't willing to sort of pack it in and go home just yet.
Now, Adam, we did have some news overnight about AstraZeneca getting another bid offer from Pfizer, over $100 billion. I mean, it's a huge number. But back home in Australia, we've also had, a few sort of IPO and M&A stories. Queensland Motorways had a much bigger bid than expected. Spotless is going to be IPO'd at $1 billion. How does the market see an increase in M&A and IPO activity? Is that a good sign for investors?
Yeah, because investment banks love it, and everyone knows that if investment bankers are happy, then everyone else is happy because they have a spring in their step, and all the research they put out is just that little bit more positive. So yeah, it is a positive sign. People have been looking for an IPO, an increase in M&A activity for a long time. We saw that at the beginning of the year. It's been so weak for such a long time that it's a good bet that we cashed up companies. We're going to see that activity increase quite dramatically.
What's interesting, though, if you look at the statistics about takeovers, that often it's the acquirer who's the one who loses most of the money because generally they end up paying too much. And Australian companies, are pretty well valued, one would say. So do you expect more takeovers to come?
Well, yeah, I do. And look, getting back to the issue of paying too much, we normally do see that in a very mature bull market. I don't know that we're at that point just yet. Certainly the bull market's been going for a while. But I don't think we're at the point where companies, given that real economic growth, given that earnings growth has yet to fully come, into fruition, that we're going to see acquirers paying too much at this point. There's not too much blue sky out there, I don't think.
Adam Carr, thanks very much.
Pleasure. Thank you.